All right, so we're going to start today's lesson. You got a little bit more background or some background information on what exactly a mutual fund is. The purpose of this is to go into a little bit more detail about what it means to invest in a mutual fund, what happens to your money, and then also giving you the opportunity to research some mutual funds and learn about the different types of mutual funds that are available. Some of them will be available to add to our investing simulator. So once you're done laughing at the hilarious cartoon that I hand selected for you guys, let's think about not putting all of your eggs in one basket. Let's think about a time where we've heard that quote and the purpose or the context of that quote. And so at the heart of it, it is really, it applies to a lot, not just investing, but we look at what happens if we put all of our time, our energy, our efforts, our resources, and in investing examples, our money into one particular thing. Whether that be, again, I'm going to invest all of my time into doing one specific thing, or I'm going to invest all the resources that I have into one specific thing, or I'm going to put all the money I have into one specific thing. We can see very clearly that, yes, there is some benefits to that. If I put all of my efforts into writing the best college essay for the one college that I want to go to, that essay is probably going to be pretty good. But what happens if I don't get into that school? All right. So likewise, I might put all of my money into one particular company, and I may make a lot of money from that. But what happens if that one company doesn't do so well? All of my eggs, in this case, money, would be potentially lost. So we're going to use this somewhat simple quote to teach us and learn a lot about diversification and mutual funds. We come back to this chart that we saw in our data crunch from previous classes about the impact that bonds have on an investor's portfolio. And so right off the bat, we can look at and we can see the impact of what diversification has when we are not putting all of our eggs in one basket and when we are putting all of our eggs in one basket, both on the very beneficial side in terms of being 100% invested in stocks, where I could have earned a 54% return, all the way down to if I was 100% in bonds and earning a 32% return, and then everywhere in between. So while this image was focused or was part of our bond unit, it also, again, teaches us a lot about diversification. What happens when we don't put all of our eggs in one basket? And as we talked about, the range from the highs and the lows certainly decreases, but also, as we can see, our average return decreases as well. The way I like to introduce diversification in mutual funds is imagine if you have some leftover M&Ms for Halloween candy, this would be great. This is typically the time of year where I have leftover Halloween candy that I'd be sharing with you guys. But if you opened up your M&Ms and if you sorted all of the colors by assets or by asset class, and so let's say the blue M&Ms represented blue chip stocks, Coca-Cola, McDonald's, Walmart, not necessarily those companies, but examples. Greens were growth stocks, so companies like Tesla and Amazon, maybe Facebook. Yellows were some IPOs or startups, Spotify, Dropbox, Peloton, some of the most recent companies that have gone public. Orange would be your consumer cyclicals, so companies that are closely tied to the economy. And then we would add some bonds, some treasury securities, and then anything else that we didn't have spent would be held in the form of cash. And so when you open up a bag of M&Ms, you basically have a mutual fund in front of you. You have a mixture of different assets. And within those assets, you have a mixture of different types of investments, different classifications of stocks, but then also different sectors and different industries. So let's look at what happens when we invest. And so let's say you have $1,000 in your investing options. Okay, you could invest into one or more companies on your own. So you could do the research and you could figure out how many shares you can get for or in a particular company. Think about the advantages and disadvantages of that. You have to do the research yourself. However, you are in complete control of the decision and any profits that get or any returns that are earned from that decision are completely on your own. Now, as we start to talk about mutual funds, let's look at what would happen if you decided, let's say we took everybody in this class. We have 28 students in this class. Let's say we pooled everybody's money and now we have $28,000 to invest, and everybody's going to give it to me to invest on everyone's behalf. Let's think about the advantages and disadvantages. Well, right off the bat, you're putting your money in control, or you're putting your money in the hands of somebody else. So not a lot of people might feel comfortable with that. But imagine what you could invest in with $28,000 versus only $1,000. And that's really one of the main problems that mutual funds solve, is access to or the ability to diversify without a large capital outlay for most investors. There are a lot of companies that I could not even invest in if I only had $1,000. Companies like Amazon, or maybe even some of the more expensive stocks, I could only buy portions of shares because of that. So real quickly, pause the video here and let's think about what would it take for you to pick option one, $1,000 into one company or on your own. And then two, what would it take to pick option two and pull your money with everyone else? Take a moment and think about what that would take. All right, so some initial reactions. Why not buy your own stocks and create a personalized mutual fund? Why have mutual funds become the most popular investment choice? Well, again, it's certainly, for number one, certainly is feasible to say that you could create your own personalized mutual fund. And what many of you have done in your investing portfolio have created a mutual fund. You have different stocks in different sectors and different industries, and you have different quantities. And that was the purpose of that diversification assignment, to see just how diversified or non-diversified we are. But that can become costly if I want to increase my position in a company. And it's also timely as well. I have to have the knowledge, but I also have the time to be able to manage the fund and react to different market conditions. Well, why have mutual funds become the most popular investment choice? As I mentioned previously, they have solved a problem of diversification without the large capital outlay from an individual investor. So even with my small $1,000, I could still have a diverse portfolio without actually owning the individual companies. Okay, so every mutual fund that we researched inherently has the same goal. It's to make money. And that's the same for just about every investment that we have. All right. However, every mutual fund will not have the same strategy. They will not accomplish that goal in the same way. So the way in which they accomplish their goal, so the strategy must match the goal. So if my goal is to make money, but what is my strategy to make money? And if we thought about just what we've learned in this class so far, there's a lot of ways to make money in the stock market. We can buy low and we can sell high. We can short sell. We can purchase stocks that pay dividends, and we can purchase bonds and receive interest payments. So depending on your strategy is going to indicate what type of fund you ultimately have. Okay, so real quick, I'm going to give you a little bit of a preview of some of the things that you're going to be doing today. But this will also kind of serve as a comparison and more of a visual demonstration of what mutual funds can do. So I'm over on Yahoo Finance, and you'll see here I've got three companies, or I've got three things that I'm tracking. I've got Apple, which we all know is Apple, and I've got this TRBCX, and I'll talk more about that in a little bit, and then this SWPPX. Right now, this is a 5-year chart. So over the past 5 years, if I invested in Apple, I would have earned a 322% return. Not bad. Nobody would be upset about that. Now, these other two, this TRBCX, this is a mutual fund. This is a T. Rowe Price blue chip mutual fund. And you're going to learn a little bit more about this mutual fund in just a little bit. And then this last one, SWPPX, this is what we'll call an index fund or an ETF. And you'll learn a little bit more about that as well. So we have a single stock, that's one single company. We have a mutual fund. We have a collection of not just one company, but probably hundreds of different companies. And then we have an exchange traded fund, or an ETF, which basically invests in the overall market. So you can see here over on the right-hand side what has happened over the last 5 years. Again, we've seen, again, nobody would be upset if they earned a 300+% return over the last 5 years. Nobody would probably be upset with 121% return, and not very many people would be upset with a 73.25% return. So as we talk about what diversification does, we can see, yes, if I would have invested all of my money in Apple, I would have made a lot more money. But would I, or could I have been able to handle the swings of the individual companies, knowing that all of my money kind of rises and sets with that one particular company? Right now, I'm going to add one more thing here as a comparison before I get you guys set up. Let's look at one of the major indexes or indices of the market, which is the S&P 500. Again, that is the collection of 500 stocks, and it's the broadest measure of overall market activity. All right, and let's see where that one lies. Okay, so you can see if I would have just invested in the market, quote unquote, I would have earned a 78.5% return. Okay, all right, so there's a quick little preview. All right, so here's what you guys are going to do now. After you're done viewing these slides, there is an Ed puzzle posted in today's assignment on Google Classroom. That's going to talk about the difference between mutual funds, exchange traded funds, and some general information just about the different types of funds. Once you're done with that, I'm going to assign you guys to a breakout room to complete some research on our mutual fund of the day, which is TRBCX, the T. Rowe Price Blue Chip Stock Fund. And so I'll have some directions for you guys. While you're waiting, or if you finish this, you can certainly start to look to add some ETFs to your portfolios. If you're not sure what ETFs are, that will be covered in the Ed puzzle. All right, have fun today. Let me know if you guys have any questions.